Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the trading week ending August 3rd, 2018. What I've got on the screen here is the E-mini S&P 500 futures. First, just kind of taking a step back for a second. The S&P and the Dow, both of them have finished up now. What is that, 4 or 5 weeks in a row of consecutive gains. So the Dow doesn't seem to be showing too much near-term stress with a lot of these tariff issues, but we could see an escalation if China continues to retaliate or counterreact to what Trump does, and then Trump counterreacts China, and we can just go down this slippery path here because the Dow seems more sensitive to any kind of trade escalation issues than, say, the S&P or the Russell or NASDAQ. However, we've had 5 weeks in a row, both Dow up and the S&P up, and NASDAQ was up this week too, about 0.96, just slightly under a percentage point. And the VIX came down a pretty good bit. It fell about 10.5% and closed the week out at 11.64. That is, in my mind, very low given the potential inherent geopolitical risks that we have floating around out there across this planet right now. But the VIX last week had closed at 1303, and now it's down at 1164. So we've got to be very careful here. And we saw this week the Feds come out, they held interest rates steady. However, there's about a 90% chance of a rate hike in their September 25-26 meeting. And the markets are pricing in about a 60% probability of a rate hike in their December 18-19th meeting. So that if they do this, this would give us 4 rate hikes for the year, which is kind of what they've been saying all along. And we got to be really careful here because Power Ranger Powell is slightly more hawkish than Aunt B or Yellen, who's now gone. So we got to watch this very closely. There are a couple of things that could move us over into a bear market. One, if inflation all of a sudden really takes hold and starts moving up very strong, forcing Powell's hand to hike the rates a little bit faster than he really wants to. And that would in turn put on more monetary policy or completely tighten the monetary policy a pretty good bit. That would kind of give us a recession threat. And at the same time, we've got, higher valuations than normal. So we've got to watch this very closely. And of course, we got the midterm elections coming up here in November. So we've got a number of things that can happen in the U.S. And the U.S. right now is really the only country that's doing very strong compared to the other economies out there. But that can all switch. But right now, for instance, looking at the S&P 500 E-mini futures, as I said, we cleared this major level right here. You can see where we held up here, and then we've retested this and then retested it several times. We tried to get escape velocity. We got all the way up to 28.49.50, and then we came right back down to the 27.89 area. So we came back about 50 or 60 E-mini handles, and then we finally found ourselves back up here again. I mean, the markets just want to take out the all-time highs of 28.78.50. I mean, I see that happening, and it looks like that's what the markets want to do right now. If you look at the 50 EMA and you look at the 200 EMA, the upward vector is still fairly steep. I don't see much in the way of divergence in the MACD here, so this does suggest the markets do want to move higher. Now, we had Apple hit a 1 trillion mark this past week, so that kind of goosed the markets a little bit, especially the technology shares, which have been feeling a little bit of pressure lately, but it boosted them. So we've got a situation here where the markets are still, in my mind, a little bit of a grind higher kind of mode, but there is risk out there, especially with the volatility as low as it is right now. If we look at the NASDAQ, which has been the strongest index. And we can see here with the NASDAQ where it made a high just a week or so ago at 75.30. And now it's coming up to challenge that high. You can see the 50 EMA where it's been holding up fairly strongly. We're at a value area right now, but it seems to be setting up for a little bit more weakness. I mean, if we do make new all-time highs in NASDAQ and or the S&P 500, I'm going to be more of an active seller of the index rather than the buyer. I'd be more interested in shorting this thing. And then, of course, if we look at the Russell and look at the Russell futures, it has been showing a little bit more signs of weakness than before. Remember, coming into May and June, the Russell was leading the markets, including the NASDAQ up higher. And now we're at a pretty much at a value area right here where you're looking at volume over price. And you can see we're holding the 50 EMA. It regained it. It fell below, but we regained the 50 EMA, but just barely. And you can see this upsloping trend line. And the vector of the 50 EMA is starting to flatten out. We still got an upward vector on the 200 EMA. So I don't see the markets really in the mood right now to have a severe pullback. I do see some consolidation and chop, possibly all-time highs in maybe the NASDAQ or the S&P 500. But I don't see really anything here that'll just really just move this market dramatically higher. I mean, we're almost through earnings, and we've had a huge, strong blowout corporate earnings for this Q2. And we've still got, obviously companies left, but the rate of beat, both on top line and bottom line, are just at 10-year highs. So we've still got a very strong economy. And it's going to take either a fiscal policy, i.e. trade tariffs, or monetary policy, i.e. the Feds and Powell tightening too fast, too quick, to stop this market right now. And then finally, if we look at the worst performer, which is the Dow, you'll see here we finished Friday 118 points up, and we're right in this huge resistance zone here, right around the 25,500 area. If we can take that out, then I think we'll move up and challenge a prior pivot high at 25,813. But we got to get through it. There is no divergences in the Dow either. So like I said earlier, the Dow seems to be brushing off a lot of this talk this past week of Trump coming out and possibly upping the ante on the tariffs from 10% to 25% on the next 200 billion. Now, one thing to keep in mind is that on, I guess it's on Monday, I think it's Monday. This will be the first phase of restoring U.S. economic sanctions against Iran. They're set to go into effect Monday, August the 6th. So now that could affect the energy markets, and there could be a bleed over effect, but let's see how this thing plays itself out. If we look at the Vanguard All World Index, I mean, it's still way underwater. You can see the 2018 open price. You can see where we're sitting here down below. We're off the lows, but we're still closer to the lows than we are the opening price. And the highs, well, forget about it. We're way off the highs that were made back in January before we started rolling over. And then let's look at China. China is really having a hard time. If we look at China, we made new lows on Friday with these trade tariff talks. Remember, China gets most of its money and drives its GDP mostly by exports, not by consumer-driven spending. 70% of the U.S. GDP is consumer spending, and it is up dramatically, which is supporting the U.S. economy. But in China, it's completely flipped around. More than 60% of their GDP is driven by exports. And when we talk trade tariffs, then that really puts a damper on their GDP and their growth. Now, their yuan is also weakening against the dollar. So China is in a pickle. But keep in mind, you got to be careful what you wish for, because if China continues to degrade, it could bring the rest of the world down, the world economy down, because China is the second largest economy in the world. So this is kind of where we're sitting right now in all of this. And I have my beliefs in what we should and should not do. But at the end of the day, to be honest, it doesn't really matter what I believe. It's only what price action is going to do, right? And right now, China is showing tremendous weakness across their economy. They've got huge debt issues as a percentage of GDP, huge. And they're going to be forced up against a wall here. So it's going to be like a wounded animal. And you got to be careful when you're dealing with wounded animals here. And if Trump continues to press, it's going to be really interesting to see how this thing plays out from a price action standpoint. If we look at the Nikkei, now look at the Nikkei. their index, it is still in the red for the year. It has been moving up dramatically off the lows that was made in March, but it's still in the red for the year. I think the Japanese economy is going to be a little bit stronger. One of the stronger economies in the Asian markets, that in South Korea. But if you look at it, it's holding its own above the 50 EMA. Now, keep in mind the yen and the Japanese Nikkei, they go in opposite directions in general. The correlation is amazing. It's like 80, it's like a minus 80. So wherever the yen goes, if the yen goes down, the Nikkei goes up and vice versa. So we got to watch this because this is the third largest economy um, globally right now. And of course, if we look at volatility, as I said earlier, the VIX closed the week at 1164. Folks, that's low for the year given the risk parameters, the geopolitical risk that's floating around out there. I think we're getting a little bit more complacent than we should be. And when we get down this low, the risk of a bigger move in volatility clearly is not down, it is up. So for those of you that are following in my Option Masters education series, I showed you what can happen with a volatility spike when you're running credit spreads, whether you're doing uncovered spread, selling puts, naked puts, or you're running spreads where you're covering the short with a long. Even if you're doing bear call spreads, I showed you what can happen with a volatility spike to the downside. The markets tend to do things you do not expect. So as I'm instructing a lot of our members, we're very careful and selective in how we may or put on credit spreads or naked puts. Right now, with the risk the way it is, we're switching more towards long gamma type trades or short delta. And if we are long delta, it may be long delta in assets that are reverse of the index themselves. But you got to be and we got to be quick to take profits. Okay. So this is where I'm looking at the major indexes right now. If we look at treasuries and we come over and look at the bond market, you can see money kind of came in the bonds right here, but we're still hovering around my major support point. I think interest rates can go a little bit higher, but because there's such a large discrepancy between US rates, European and Japanese rates, that large discrepancy is going to keep money flowing into the US markets. That's going to keep the dollar a little bit stronger and our interest rates a little bit lower than what you would normally expect given the current market environment right now. But at some point, when other countries, when they start to improve, and when you see some of the fiscal policies in some of these other countries start to revert, where they're not still doing stimulus like they are in China in their own way, or in Great Britain, or in across Europe, you're going to see money get sucked out of the U.S. You're going to see the bonds roll over. You're going to see interest rates here move higher. Right now, that's not the case. So I think near term, meaning the next 6 months or so, I'm expecting higher rates, but not by much. If we look at the 10-year, which is kind of where everybody's following, you can see here the 10-year actually pulled back a little bit on Friday. All right. And you can see the highs at 3.11%. So we're still in this huge resistance zone up here. I've got a number of different indicators that would suggest this is a lot of resistance up here. And I think the near term could actually be down, believe it or not. The stronger the U.S. economy gets relative to other G7 countries, you're going to see money continue to come into the U.S. and that'll suppress our interest rates near term. Okay. Now, if we look at currencies, I mean, here's an example. Here's the dollar. And if you look at the dollar, we're near we're near 2018 highs. All right. We've been in this chop range here. You can see this volume over price. So we're near a relative value here at volume over price, but we're still at near 2018 highs. Whereas if we look at the euro, and it's the euro currency, just a standalone by itself, we're down at the bottom down here. Now, as you guys remember, I've been doing this every Sunday, or every weekend rather, for our weekly roundup. I'm projecting the euro to come down and find a little bit stronger support around 114. That would suggest we're going to take out the 2018 lows. We're going to go lower, and that would suggest the dollar moving higher. British pound, same thing. I've been bearish the British pound ever since we got out of our bull trade in this upsloping channel here. And this suggests the pound can go a little bit lower as well. All right, I think there's going to be unintended consequences of the Brexit. I think longer term, meaning the next 5 years or a decade, Britain separating from the rest of the European Union from a monetary policy, fiscal policy standpoint makes a lot of sense. There's just going to be a lot of pain, and I think in the near term, the pound is going to come down even lower, so it's going to get pounded more. Okay, so that's kind of where I'm looking at from the currency's perspective. And if we look at metals, look at gold, guys. Gold is just getting crushed. Right now, we're near the 2018 lows. The gold, and it actually came down and almost touched 2018 lows. We're off of the highs for 2018 of about 11.59%. That's a huge move lower. We could not hold up here, and I've been bearish gold since. I have not taken this move. I've suggested to our members that if you're going to do anything, any rally in gold should be sold right now. All right. I think it can go lower, but I'm also going to reverse my tone and say that over the next 3 years, gold is going to be over 1400. When the U.S. markets are ready to roll over, that's going to be the time to shift our stance and move long gold. All right. Same thing with silver. For short term, no, I'm not. And of course, if we look at copper, copper goes where China goes. Look at this copper trade here. I mean, this is a daily chart of copper futures. I mean, when we started talking tariffs, it just fell off the table. If we put it on a weekly chart here, just to step out and look at copper. I mean, look at this. This was a high made in 2017, and then we could not get higher, and then it's just been going down since. When China starts to stabilize, then I think copper's going to reverse. But right now, no, I would not want to be long copper at all. It's going to go where China goes. And then, of course, if we look at oil, I've been saying for a while now that I think oil's near-term move is more downside than upside. You can see this upsloping trend line. If I step it out a little bit, you can see just how far back this goes. It goes all the way back to 2017 in the summer. We've touched it a number of times. Every time we broach it, we immediately get back up higher again. Okay. And now we're coming back down, and we're riding this trend line. So the upward vector is still intact for the 200 EMA. The 50 EMA, you can't see it, but it's slightly pointing down. I think oil probably could find itself back down in the lower 60s near term. Okay, that's where I see it. And then I'd be more interested in taking a long position. Right now, no, I think it's going to be chopped to slightly down. All right. And then, of course, if we look at Brent oil, you can see the same thing. Here's the channel, upsloping channel, and you can see how Brent has been following this upward vector. You can see here where we broached it. We're trying to get back up above, but you can see the 50 EMA started rolling over sooner, and it's been pulling back a little bit. Okay. And if we look at the difference between Brent and WTI, look at this spread here. This is amazing. Now, up at this level here, I was having our members, we were shorting the spread between Brent and WTI, all right, which is the U.S. West Texas Intermediate oil. And boy, you can see this move down. It's $1,000 a point, all right? And you can see this roll over here. We were shorting it up at this area here. Remember, the 5-year average of the Brent to WTI spread is around 5, and we're slightly below the 5-year average right now. Right in this trade here, it's a really tough trade to make. It could go either way, 50-50. But when you get dislocations like this, you got to play the spread. Whether it's dislocated down low or up high, you just got to kind of play that spread. Gasoline, I'm more bearish gasoline than bullish. And you can see here, we're coming into the end of the summer season here. I think gasoline is going to come down and test 199, the futures, and then come down below 199 a gallon and come back down to the low 190s area after we get through the August period here. So going into the fall, this tends to also be the seasonally weakest time of the year for gasoline futures. And for those that can't trade the futures or don't have the appetite for the volatility, you can do UGA, Uniform Golf Apple, which is the trade in gasoline to the downside. Now, for those that have been following us in agriculture, we've been doing very well in ag. You can see where both corn and soybeans really took a dive. And China was playing this thing here. And like I say, the beautiful thing about commodities is when you get extreme positions, and you get a little bit of an anomaly in an extreme position, that's the time to play the other direction. And that's what we've done. And we chose soybeans as our venue for that. You can see here the huge move in soybeans. China was out there up to no good in the soybean market. When soybeans fell, China bought almost a half a year's worth. Soybeans, corn, wheat, that's one of the few commodity products that's like oil, easily storable, and it's commonly storable. And you'll see China playing games where they'll buy a lot of soybeans at a cheaper price. They use soybeans primarily to combine and feed their pigs because lean hogs is very big over in China. But they're one of the largest buyers of U.S. soybeans, and now with the tariffs and everything, that's what caused soybeans to totally get dislocated. Okay. And so you can see this dislocation here, but we've been playing this in our secret trader in our user group and been doing very well in it. So we love these dislocations. So that's what's going on. There's a couple of potential trades setting up in the softs market as well. We'll be looking at these for our members this Sunday and our weekly market watch. And then we've got our option masters again this coming Thursday. If you're not a member of our group, I highly encourage you to come in because everything is global. We're into currencies and commodities as well as U.S. equities. And now that we've got a plethora of ETFs to play these things, there's a number of different ways to play. So if you can't get into the futures market, you can certainly find an ETF to play. And we're taking advantage of that this year. I think this year, just the way I'm looking at the charts now, we can still grind higher, but I think the real excitement is going to kick off in probably springtime, summer of 2019 into 2020. All right, everybody, that's kind of the update for this week ending August 3rd. Members, I will see you this Sunday night. If you're not a member, I highly encourage you to come in. Our user group is growing exponentially for our international view of the markets. And I'd like to see you guys come on in. Otherwise, have a great weekend. And folks, I'll see you, members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao.